I'm going to share with you guys 3 ways to profit from using moving averages. And we're going to start off looking at the NASDAQ on a 1-minute chart. Now, it really doesn't matter what moving averages you use. I know the internet's going to say, no, you have to use this special moving average. That is not the case. In this example, I'm going to share with you guys using 3 moving averages to start out, and then we'll dial it back to 2 moving averages. And you're going to want to stay with me to the end because I'm going to share with you guys a filter that can be used on all 3 methods that I'm going to share with you guys tonight. Now, when we first look at this, right, we have 3 moving averages on this chart. The white one is simply a 200 period SMA. The blue line is a 50 period SMA. And the red line is a 200 period SMA. And you might say, Mike, do you always use simple moving averages? The simple answer is no. The moving averages on this chart right here are actually a 50 and 200 exponential moving average. And that's the point I want to beat across is it doesn't really matter which moving averages you use. Just be consistent with them and don't always try to change them around. So the first method I'm going to share with you guys is if you have 2 or more moving averages on your screen, then what we can do is we can look for crosses of the moving averages. And no, I don't mean buying right when the moving average cross or selling right when they cross to the downside. Trust me, when I started off trading back in 2005, I tested this many times. There will be hot streaks in the market where that will actually work, but over the long term, it simply is not a winning strategy. But instead, the way we want to use the moving averages crossing, we want to use this as a filter in terms of should we be looking for buy side trades or should we be looking for sell side trades or simply nothing at all? You might say, Mike, what do you mean by nothing at all? Well, before we talk about that, let's talk about what would constitute a bullish scenario in the market. In this case, we talked about the white line being a 20 period SMA, which is the faster moving average. We want that above the blue line, which is a 50 period moving average. And we want the blue line above the red line. So that way we have a bullish alignment of the moving averages, meaning the faster moving averages are all above the slower moving averages. Now you can expand this out, have 6, 7, 8, 9, 10 moving averages. We're just going to keep this very simple for this video. So in this example, what do we see right here? Well, we have a bullish alignment of the moving averages. And what do we get? We have a hammer-ish type of candle. Now, I'm going to warn you guys, if you're playing this hammer candle right here, then you'd want to wait for confirmation, meaning the break of that candle, which comes in about 453. Now, if you look, where would that trade actually be invalidated? At least below the bottom of the candle. And that would come in at 20,434. In my book, that is way too much risk to have on this trade. Yes, it goes rocketing to the moon. You could have made plenty of money on it, but what if I told you there's a better way that we can trade something like this? Now, if we go ahead and we look over here, do we simply want to trade every single hammer candle? And the simple answer is no. We want another criteria. We did have a hammer candle right here, but I want you guys to pay attention. Are we near the moving averages? No. Anytime we are stretched away from the moving averages, guess what? That actually brings me on to strategy number 2, which when we get too far extended away from the moving averages, we can look to play a regression back to the moving averages. So whenever we get too far away, think about a rubber band being pulled back. When you let it go, bam, it pops right back to where? The starting or the resting point. Now, if you guys join me during the live streams, you'll see me do this quite often. Well, here was one attempt, too far away from the moving averages. And then we went a little bit lower, added the second one, boom. Ended up being a profitable trade. And during the live streams where I stream live during the Asia sessions, you guys see me play this trade out time and time again. And like with anything, there's other filters you can add. For instance, we have a bearish alignment of the 2 moving averages. This one right here is a 50 period EMA. The one up here is a 200 period EMA. Well, guess what? As we're coming down, we can look at Delta. Look at what it was roughly over here. Well, Delta was huge. As we came down, which correlated with this swing point right here, look where the Delta was. It was not that large. And then as we came down and made a final low, was not nearly as low as that other Delta, which basically signified to me, you know what? Maybe, just maybe, we're going to turn. We have more than one reason. We have another reason to take the trade. Keep in mind, the moving averages, as you are starting to learn, nothing more than a point of interest. We still need more. We're not simply just trading off the moving averages, but they are giving us an idea. Look at this example right here that we had on the NASDAQ, and this is from Friday. I'm trying to use recent examples. We had a bullish alignment of all the moving averages. Was there any reason to be looking for sell side trades all along this area? Well, not unless you wanted to try to make money the hard way. But look what happens when we come over here. Now we get the faster or the white line starting to cross below the blue line. So right here, we have the very shortest term being bearish, but both of the moving averages are above the longer term moving average, meaning the 200 period moving average. So what do we do in instances like this? Nothing. Not every single candle is a trading point on the chart. Right now, we want to wait until they come back into alignment before we ever even think about looking for another trade. Now, let's talk about the third way we can trade moving averages. And then I'm going to show you guys a very simple filter that we can use to basically enhance any of the setups out there. Now, the next one is going to be when we come down and touch the moving average. So in this case, we're basically touching the 50 period moving average, and then the market bounces away. And what I will tell you is on a daily chart, when the market touches a 50, quite often you will get a very significant bounce off that moving average. But keep in mind, I don't really care what period moving average you're going to use. But again, we still have the same problem that we had with this example over here, where we had a bullish alignment of the moving averages. We have a hammer candle because if we look right here, our entry point would be once price starts breaking above this hammer candle at about 537. And if you look down here at the low, we have the bottom of that candle at about 521, where that candle will be invalidated. So you're going to be risking 16 points on this trade just to find out if you're going to be right or wrong in this trade. Now, in this example, did the market go substantially higher? Yes. Why was that the case? Well, it's very simple. If we look at the alignment of the moving averages, which way were they facing? Were they facing up or were they facing to the downside? So now I want to go back and revisit the first trading opportunity we talked about. I want to revisit the second trading opportunity, which is the bounce off of the 50 period moving average. Then I also want to revisit the trading opportunity where we look for the price to get too far stretched away from the moving average. And I'm going to show you, and we're going to start off looking at part one of the filter. Now there is two parts. The first part of the filter is going to also identify that is going to validate that we should turn at that point. The second part is actually going to show you exactly where to enter on that trade. So as we come back to 9:45 a.m., now I'm going to introduce you to a tool called Bookmap, and I want you guys to pay attention to something very obvious. The red line right down here represents there is a lot of buyers willing to buy at that price point. We have 311 contracts ready to buy. And think about this from a logical standpoint. If there's more buyers looking to buy an asset, is it likely to go higher or is it likely to go lower? And if you look at this, this is right here at 9:45 a.m. And let's just look, that resting order is sitting there at 20,432. When we come back over here, and we look at that chart, 20,432 is where? Right below that 200 period moving average. So if you were looking for the bullish alignment of these three moving averages, yes, they're intact, which says the market should go up. Then we see a large buyer or buyers wanting to transact near that level. Then all we need is the second part of the criteria to show us exactly where to enter the trade, which we'll talk about here in a few moments. So certainly that doesn't happen each and every time. Now you're probably saying, Mike, that was a fluke. Well, let's go look at the next one. We came right next to the 50 period moving average. Look at the time period. That is at 10:23 a.m. in the morning. So look right down here. What do we have? We had a large buyer wanting to transact down here at this price, right? The large resting order, which can already be seen out there well in advance using Bookmap. So if we have a large buyer sitting right down here at a price point of 20,522, and we're looking at price coming very close near the moving average, which the low on that candle was 20,522. Wouldn't it make sense that the market is likely to bounce? And guess what? If we're wrong on that type of trade, which I'll talk about how you can get, how we can actually look for the trigger to get in, guess what? Your stop loss could be right below that large order in the market, which would help us not have to wait for the confirmation of a candle to start breaking the high of that hammer candle and risking well over 10 points on the trade. We can risk fractions of that on that trade. Well, what about this trade right here where we talked about we had the delta? Was there also a large buyer down here that actually caused the market to go back up once price was too far extended away from the moving averages? And look what we had right below that level. There were some buyers. We didn't quite make it down there towards that area, but we did have another way by using Bookmap how we could actually enter the market. But guess what? Where are we wrong? If we start breaking below these large levels, then we can go ahead and invalidate that trade idea and go ahead and chalk it up as an L on that trade. But knowing this ahead of time, guess what? If you're looking to build into a position, this is the area that Bookmap is showing us exactly where we're going to be wrong on the trade, because if we start breaking through these larger orders, guess what? Price is likely going to go substantially lower. Now, if you want to see how to use Bookmap to actually enter on these type of trades, watch this video right here.